Hello, thanks for joining into the Farming Banker presentation here. Welcome to the 2022 German American State Bank Ag Seminar. This is the second year that we've done this virtual Ag Seminar and have gotten a lot of good feedback, so I appreciate you guys tuning in. I am Jeremy Dutch, I'm the Farming Banker. I have been a commercial lender for over 20 years. I've been a part of our family farm my whole life. I'm still involved with it. I manage our hog operation. If you want to learn more about me, you can go to the best way to do that is to go to this website by the name of farmingbanker.com. You'll have a link to the bank's website. You'll have a link to the Dutch Farms website, and you'll have a link to my Farming Banker podcast, which I talk about a lot of different things, some of it on the farm, some of it within banking, that type of stuff. And so you can find that on the website of the Farming Banker and learn a little bit about me. Quick little deal here. I always like to do is give a shout out to my family. That's my wife and two boys. Dutch Farms has a saying, farm, family freedom. And so you can see there's my family. There's pictures of the farm. And in the background here, you can see I got my American farmer hat on, the American flag. So I'm living the farm family freedom. So I just want to talk a little bit about a couple of things that I'm hearing a lot of repetitive questions during this year's renewal season. And it got me thinking, about a couple different scenarios to talk through and really a larger picture of, how do we use, and I don't think we talk a lot about this, but how do we use finance to protect our farm legacy? And so I want to make it relevant to, obviously 2022, the concerns and things that are out there, what's going on. And so I've picked kind of the 5 most talked about topics in this year's renewal season. And so I'm going to work through, what are the probabilities of some of this to get down to, how do you use finance to protect your farm legacy? So here we go. First one is Russia-Ukraine resolve. So if you look through this on the left-hand side here, I've got what's the probability it's going to be over in 30 days. And so you've got, kind of I've just picked some targets here. You either think that there's no way and that it's going to be over in 30 days, or we've got a pretty darn high chance that it is. And so I just over on the right-hand side, I've kind of said, well, let's just break this down and let's look at where our own personal risk tolerances are and how we want to manage this. And so if you think it's under 50% that we're going to have resolved to this, then I think we need to be thinking about these 5 things here. I think we need to be looking at a potential for higher commodity prices. Ukraine has said that they're looking at planting intentions of about 50% of what their normal planted acres are. I think with sanctions and some of the stuff that's going on, we've still got to look at higher energy prices, fertilizer shortages, more government spending and aid that could be, that potentially could go out. And then, does that result in any kind of acreage shifts? And so, because of the prospect of maybe wheat being profitable and corn being profitable, does that shift some of the acres over there? We either flood the market, we have, continued fertilizer shortages, or does that pose a rally in the bean market because we could have some shortage there? So I think you need to get your head wrapped around these things if you think there's less than 50% chance of that being done in the next 30 days. Land values, that's another one. A lot of people are going, where are land values going? And we've got, obviously a huge, I think in later slides, you're going to see, I think the numbers are about a 22% increase in land values and about 11% increase in the average rents. And so currently, I guess I pose this question to everybody is, what do you think the probability of a land value decline is? And if you think that's under 50%, then let's get our head wrapped around potentially seeing higher rents. I'm going to skip inflated competition, come back to that. So higher rents, increased leverage, is in potential equity harvest, because obviously as values go up, rates are historically still low. Does that mean that we've got some chance to harvest some equity? But that also comes at a cost that increases your leverage. Coming back to this inflated competition, farmers were always like this, and this is a little bit of an anomaly, but when we hear land values are going up, we hear rents are going up, we all start scrambling to jockey for some more land before that goes up. And so that kind of drives what I call inflated competition to the market of trying to capture this land, trying to get in on some stuff as we feel there's a huge boom. And so just be aware of that, mentally, to get yourself, we're not being silly with some of our land purchases or rents unless you absolutely need to burn some money. Oil, natural gas, propane. This is a huge topic. Is these three things are huge into some of our inputs. Obviously, oil is related to the fuel, natural gas is related to the fertilizer, and propane is related to the drying cost. And so, I just look at what's the probability that these prices fall. If it's under 50% probability, then get your head wrapped around these three things. And that's multiple input costs that are on the rise. With drying costs, fuel costs, fertilizer costs. Acreage shifts. If it costs more to put in a corn crop and to dry it, does that move us into other acreages? And then does that affect the supply and demand curve of that? Because if you listen to Greg McBride's, he always talks about ending stocks and carryouts. And so if we have less corn, can we move that, and we go into more beans, would we move those ending or supply numbers and ultimately shift that curve to either inflate or devalue some of the commodity prices just with acreage shifts? So I think those are the things you got to wrap your head around. I've got some ideas on how to secure some of these prices, but obviously, multiple input costs increase in the next few years. This is something that a lot of us are looking at. A lot of us are talking about. Probably these acreage shifts in the supply chain of demand, I think, is maybe another year or two out if we stay in this to be worried about. Inflation, this is a huge one right now. I think that, all of us at this point have probably heard that the inflation has never been this high, I don't know, since 40 years ago. That puts us right around 1982. And so, we remember in the ag industry what the 80s were like. It sounds like our inflation is roughly at that same point right now. So it's top of mind. So what's the chance this inflation declines? Is it under 50? If it is, then we got to be, wrap our head around the fact that, costs are going to continue to be on the increase or where they're at today. We're going to continue to have supply issues because I think we'll start seeing some bulk purchasing and hoarding if we continue to see, inflationary pressures. Interest rates in my segment, this is probably the biggest one and the one that we track quite a bit. And so, ask yourself, what's the chance of that you think that these interest rates are going to decline? If is it under 50%, then let's get our head wrapped around and start looking at a couple things this way that just says, hey, if interest rates go up, obviously our purchase power declines. And so I think there's roughly about, if 1% increase in rate, you've got about a 10% decrease in buying power is roughly the correlation there. So, as interest rates decline, do we, or if interest rates raise, we've got a decline in purchasing power, which does affect land values. If land values, would fundamentally come down with these interest rate increases, then we potentially have some equity harvest declines or chance to be able to pull some of that equity out if we need. And then obviously we've got increased cost is, one of the costs on the farm is what, your interest cost per acre or interest expense, however you look at it. So, as all these rates, as all of these inputs and things rise, we get to the kind of the main segment of this, and that is, what are ideas based on these probabilities? So if you work through that and said, hey, these are where I think my probabilities are. This is my risk tolerance profile. What should I do? And so this gets into where I'm talking about how to protect or how to use finance to protect your farm legacy. And so before I get into it, I just want to give you a couple outlooks. I've broken it down into two things. I've broken down into supply chain and inflationary issues, and then land values and interest rate issues. And before I talk into the supply chain, I just wanted to look at a couple charts here. And if you look at this, this is the current price and then the signal, whether it's going higher or lower, and the outlook for the next 4 quarters. And so if you look at fuel, the two oil markets here, we're looking at somewhere probably in that 115. It looks like natural gas potentially is on the decline as we open up maybe some more supply. Obviously, gasoline's up, heating oil's up, coal's up, everything else. Propane down here is up. And so it kind of looks at, in the supply chain and inflationary issues. As I get into the next slide, we start talking about, hey, is there some strategic times to purchase this? And I just want to give an example of what I'm talking about. So if you look over at this Henry Hub natural gas historic patterns, we see that typically you've got the black line, which is a 15-year trend, and the red line, which is a 5. Somewhere right before April is when we see a decline, and then again right around October. So if you're purchasing LP, to dry or to heat your shed, your shop, I don't know, hog farmer, whatever the case is, let's make sure that we're looking at what these markets are here to basically try to hedge against inflation. And I would say the same thing as you look at this chart over here that shows everything with the signal of this on the high side. Let's put that in perspective with our other inputs. So what I've done on the supply chain and inflationary side, I've taken Russia worries, oil worries, and inflation worries, and I've lumped. If you are in that camp that you've got less than 50% chance of these three things, this is what I'm suggesting in the supply chain and inflationary issue, and that is to use short-term finance to secure inputs to get it to your farm. And so on the line of credit or short-term borrowings that you would use, can we purchase volume discounts? Can we buy it in bulk? Maybe we look at 2 years of inputs on some of this with fuel and propane. Maybe you've got a way to store fertilizer if you're purchasing dry fertilizer, or potentially 28%. Or what's it cost to be able to do so versus your return on that investment. So I think we need to be looking at some of this stuff. If we're talking about high prices and supply chain issues, how do we get it to our farm? How do we use finance to get it to our farm? And then also, how do we do it at the right times of the year so that we're buying in low periods and we're using short-term finance to do that? And so that's really what these top 2 bullet points are talking about, is that in itself. On the other side of it, if you turn into what can we do here on the line of credit to hedge our interest rate risk, I'd be looking at something on the short-term supply. If you're going to use this to buy some your inputs for a couple of years, let's look at some ways to lock some of that interest rate so that inflation, supply chain, interest rates, that doesn't also kill you on that side. And then again, my last bullet point here that just says, can you buy in low demand off-season times? Again, I've talked about it. Can you go to your ag retailer and say, I'd like to buy, all my potash right now, or I'd like to buy all my DAP right now. Is there a way that you can do that, late spring rather than in the fall? Just ideas such as that to see if you can get some discount. And the other one I didn't talk about that is becoming more and more prevalent. We do this on the seed side with some dealership opportunities and lumping in some of our farm neighbors, things of that sort. Can we do the same thing with the input side? Can 3-4 farmers pull that together to get some volume discount? And so I think those are all ideas that we can work through if you're in this supply chain and inflationary worry based off that probability matrix. Interest rate land values. This is the one that I hear obviously all the time being a banker. And so I've got a couple outlooks, ideas, but let's just look at this chart and see what it is. And if it's busy, I'm sorry, but I think it'll tell the story. And so you can see right here in this major dip at this point in time, right? It in roughly where between January and July. That's COVID. That's when COVID happened. We stayed flat for a little bit. Our 10-year money, which is the blue line, started to price in some premium, then fell off, and then kind of is moving back up. Our 5-year did the exact same, but at obviously a higher rate than the 10-year. And then the 3-year, which is this kind of orangish one, fell off, hung down here, and then this is really taking off. And so The other one is this kind of what we call the 30-day, it's a 4-week kind of 30-day. It fell, it's kind of bumping along. And as you can see over in this last little bit, it's had some movement and obviously, Fed monetary policy and such potentially might influence this. But if you look at this chart, this is where I'm trying to get you to think about is that where is our risk on in interest rates? And I am kind of in this camp that our risk is 3 years and less. If you were to look at some yield curves on the 5 and 10 year, they're actually closer and kind of flatlining off. But there's a lot of volatility in the interest rate market that's under 3 years. And so let's if you're in these probabilities of land values going up and not going down, and interest rates going up and not going down, then let's manage a couple different things here. And so here's what I'm looking at on that side of it, is that we got a lot of short-term volatility, 3 years and under. I think there's long-term uncertainty within the 5-year plus market, just because we're starting to see those yield curves come together. So I think that we need to manage the short term. What happens in the long term, I think, depends on what happens with this Russia-Ukraine supply chain, inflationary issues, all that kind of stuff, and yet to be determined. So in the near term, even though that we're talking about rates and rising, long-term rates are flat. So our land values are up 22% in 2021, and our land rents are up 11% in 2022. So under this, how do we manage this part of it? So how do we manage the short-term risk and the long-term risk? And at what cost is that? Do we have a rate lock versus a floating on the short term? Which costs more? And then what is the cost to not hedge your risk? And so, I kind of pose this question of here, what to do. So you work through your probability pain points, and let's use those pain points to manage debt in your interest rate mix. And so here's kind of my bulk at the end example. And so if you were able to take 50% of your operating line, and let's say we did some finance that allowed you to borrow, 2 years worth of inputs, and we took 50% of that and we locked that for 2 years. That 2-year rate is going to have a little bit of a premium to it than versus the floating rate, but you're going to have that lock for 2 years. So if our probability thinks that in the next 2 years, interest rates are going to increase about 2%, which is roughly where they're thinking about. Today, we can potentially lock maybe 1% above what you're floating at, and you would have that locked for 2 years. And then as you float up on the other 50%, you would absorb that cost as that moves up. And so here's what that does, and this is why I kind of like this, is it, we're taking interest rate premium and we're going to put it in this year where there's high commodity prices and there's very favorable revenue protection. And so we're going to pay that in this year when we've got good margins. And as we're looking at the margins for the following year, there's a little uncertainty in some of the December commodities and such are showing slight declines yet to be determined. But we're going to get that value back out in year 2 if rates go up. So we're kind of hedging our interest rate risk here on the short-term side. So I like that idea. On the long-term debt side, what I'd really like to do is I'd like to be saying, hey, there's not a lot of premium to go from that 5 to 10-year rate. Let's take and lock in all of the fixed assets that you can't afford to have adjust. And so, if you were looking at farms that you have purchased, homes that are part of your family farm, land, things of that sort that you can't afford to have go up, let's look at what, kind of an average land rent equivalent would be. So if it's around that 300-400 acre range that you're looking at, let's lock that portion of debt payments up into a period of long-term interest rates, and then let's take a look at 5-year debt on the rest of it. Because one of these things, if you look at this 5-year debt and other fixed assets, one of the things that we're thinking is that that's pointing to this with a lot of the spending and such is that do we have a recession on the horizon? And I guess by using all of that, that helps manage some of that risk. So how do you use finance as a wrap up? We're going to secure raw goods for fertilizer, seed, fuel, trying to do it at reasonable cost, see if we can't purchase inputs in off-peak times. And then, does all of this allow you to save 10-20% in a timing/volume discount, including your interest cost? And then the other thing is, because of the uncertainty, we got to preserve cash. And so for an example, we ended up doing a seed and fertilizer special last year. Gentleman came in and used it to purchase his fertilizer and some of his seed, used it in August, and he figured that if he would have purchased it in December during his normal times versus August, that August purchase, including the amount that he borrowed with us, saved him about $100 an acre. So this is real savings that we can take a look at, and how you can use finance to protect your farm legacy. So that's pretty much it. That's a wrap up. If you guys, if you need a farming banker, visit www.farmingbanker.com. The thing that we like about this is that we think like farmers because we are farmers. So thanks a lot for tuning in. We'll see you guys later.